So, hello everyone. Merry Christmas and Happy New Year. I hope this new year will be a better one. 2024 will be a more fruitful and better one. Today we will be talking about swing trading. It's also one of the methods or styles of trading. We discussed previously two other types of trading. One was day trading and the other one was scalping. Today our topic will be swing trading. So, starting with So the webinar aims to help participants to know and analyze swing trading strategy. Your trading style dictates how you approach the markets, how often you place positions, what your profit horizons are, and more. So let's start out by looking at swing trading, one of the most popular ways to trade the currency markets. So swing. So what is swing trading? Swing trading is a strategy that looks to profit from the oscillations that occur within the wider market moves. Swing traders will seek trading opportunities within a time frame that could be anything from a few days to several weeks. It is distinct from day trading, where it aims to make a profit within a day, and it's also not a long-term play, like position trading, in which the trade can be left alone for months or even years. When swing trading, you're aiming to profit from a small part of a longer trend within a given market. Even within strong bull or bear moves, most assist see a substantial price action against the prevalent trend. Swing traders attempt to use that price action to earn their return. For example, let's say that British pound USD goes on a bull run from 1.3245 to 1.3478 over several quarters. So 1.3478 minus 1.3245, we have, or we're just gonna, yeah, it's like 2 point something points. Indeed, there may be days or even weeks of negative action as buyers and sellers vie for control. Swing traders look to trade these smaller market moves. They'll try to buy or sell a market at the beginning of a mini trend, or what we call swing, and keep their position open until it ends. Swing trading forex can be very fruitful. A swing trader is not concerned with long-term value of currency. They are instead looking to profit simply from peaks and dips in momentum. The high liquidity, tight spreads, and 24-hour-a-day nature of forex market. During market hours, all work in favor of swing trading. Swing trading, for example, New Zealand dollar versus dollar. On the chart below, the general picture suggests a downward trend in the value of the New Zealand dollar. However, the swing trade depicted actually captures an upward movement. So as you can see here, our chart, our position here from buy, this is the trend, swing, sell, where it's going, where it's moving. So we look at the orange horizontal line, okay, this one. This represents what is known as a level of key support between late May and the middle of June. We can see that it was tested on 3 separate occasions but held up. However, after a period of recovery, the New Zealand dollar plunged past the 0.649 level and continued to fall. It was at this point that the possibility of a swing trade loomed into play. By the time it reached 0.630, it was already trading at around 9% below where it was in March. In fact, New Zealand had not been worth as little as 63 cents in 4 years. Looking for consolidation, have another close look at the graph where the red arrow is. If you look hard, you can see that having been in free fall for weeks, the chart was consolidating at around the level 0.630. This is a common indicator traders will use to forecast a swing opportunity. Remember, we are not looking at the long-term value of a pair, but rather its potential to experience a quick price movement in the near future. So the red arrow indicates what, with the value of hindsight, would have been an advantage moment to buy New Zealand dollar. When you hear talk about buying the dip, this is exactly the type of situation a trader is seeking. So closing the trade, initially New Zealand dollar plunged even lower, but then rebounded sharply so that within a few days it was up close to 0.645, where the green arrow is positioned. Okay, where I'm showing now the green arrow sell. A trader who then closes the position somewhere around here, having bought somewhere around the red arrow, has successfully executed a swing trade. Consider the importance of discipline here. A trader who wanted to hold their position and wait for an even bigger profit may have encountered problems. The line soon swung back down, eating into any potential profit. The 0.64 mark was not reclaimed until November. In fact, it's very important not to be guided by emotions and remain clinical in all aspects of trade execution. Please be aware that past performance is not indicative of future results. It's only graphs, screenshots, analysis to apply and make it more easy. So how do swing traders find opportunities? Like scalping, swing trading usually involves using technical indicators to decide when to enter and when to exit positions. A common technique we've used above is to identify areas of support and resistance, which typically see the reversals and price direction. We covered this in more detail in the technical analysis course, but here we can introduce a common technical tool used in swing trading called RSI. Below is a EURUSD chart with a relative strength index, the RSI, positioned directly beneath it. So RSI stands for Relative Strength Index. RSI is a momentum oscillator that measures the speed and change of price movements. The RSI gauge oscillates between 0 and 100. Traditionally, RSI is considered overbought when above 70 and oversold when below 30. On the chart above, the purple band represents the 30-70 range, when the chart is neither overbought nor oversold. However, when it trades below 30 or above 70, the needle leaks into the white. This can be considered an opening for a swing trader. However, RSI momentum oscillator that measures the speed and change of price movements. The RSI gauge oscillates between 0 and 100. Traditionally, the RSI is considered overbought when above 70 and oversold when below 30. Buying when a market is oversold. Let's look at the two green circles now. The lower circle indicates a breakout below 30 on the RSI metric and suggests a market that might be oversold. It suggests a buy trade at this point, and sure enough, the RSI suggestion proves accurate as the market rebounds strongly at this point. Selling when a market is overbought, but at some point there will be another correction. On our chart above, the market enters overbought territory at the blue circle. By opening a short trade at this point, you could make a steady profit. However, RSI is not a tool that guarantees successful trading every time. The lower red circle represents another significant dip into the white. This time, it's not replicated with a rebound and a bearish trend on the graph above. It's important in trading to be aware that not even the best traders in the world will be right every time. The key to being trading profitably is to be right the majority of the time and to manage your risk effectively when you've made the wrong call. Swing trading takeaways before we end up. Swing trading is a medium-term approach to the markets in between day trading and position trading. Swing traders look to profit from smaller moves within larger trends, and you can employ a range of technical tools when swing trading, including RSI.